All right, we are risk on to start a shortened holiday week. 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Dani Berger. Bloomberg Open Interest starts right now.
Coming up, big tech makes a cautious comeback as concerns over debt-fueled investment spree lingered.
And retailers hope for a holiday miracle. We're going to get another read on the American consumer as more earnings roll in ahead of Black Friday.
And Novo Nordisk shares are on track for their worst year of all time. The stock sinking today as its Alzheimer's drug fails trials.
Matt, on my mind this morning is whether the AI-related stocks have a week like last week or whether they can rebound. Let's look at what some of them are doing pre-market, because documents have shown that Amazon's data center operation is much larger than commonly understood. There are also hints of a looser U.S. export rules, reviving hopes of Nvidia's China comeback, and Alibaba's main AI app drew more than 10 million downloads in the week after its relaunch. Obviously, Alibaba the winner in the pre-market trade, Matt. But the good news is at least someone's buying the dip that we saw last week.
Yeah, absolutely. I mean, Friday actually ended well.
Yeah.
I think on hopes that the Fed will cut rates. Novo Nordisk doesn't have a dog in either fight. They're obviously concerned about getting back dominance of the weight loss drug market. And they tried to do it. I guess, buy a lottery ticket with a different use of Ozempic. They were attempting to use it for Alzheimer's. It failed tests for Alzheimer's. They were going to extend this test another year, but have decided not to. So the shares are off 10%.
All right, Matt, let's return to the AI optimism trade following a report that U.S. officials are holding early talks to let Nvidia sell its H200 chips to China. I spoke with Commerce Secretary Howard Lutnick earlier this morning.
Do you want to sell China some chips and keep them using our tech and our tech stack? Or do you say to them, look, we're not going to sell you our best chips. We're just going to hold off on that, and we're going to compete in the AI race ourselves. So that is the question. It's in front of the president. He's going to decide. It's a really, really interesting question. He's got all the information. He's got lots and lots of experts talking to him, and he's going to decide which way he wants to go forward.
For more, we're joined by Bloomberg Tech co-host Caroline Hyde. Caroline, a lot of moving pieces here, and we've heard from the Trump administration before that they would allow more chips being sold into China. There was that report earlier in the year that they'd take some revenue in trade for it. Howard Lutnick himself has had to kind of not issue a mea culpa, but has had to soften his tone when he said before, we want China addicted to our best technology. So are they going to allow these sales to go through?
Well, we're wondering whether it ends up being a moot point, because there's also Congress trying to work out whether they just stop any sort of Nvidia chips eventually going into China. But thus far, it seems to be this hawks versus non-hawks that have got the president's ear. Now, remember, Howard Lutnick, but a month or so ago, was saying we don't want them having our best, our second best, or our third best. Remember, even Trump himself was saying we're only going to ship basically obsolete chips to China. And of course, China then decided, no, thank you. We don't want your H20s. We don't want you getting 15% of that cut. I might remind you that that hasn't even gone through and been passed into law yet. So H20s can't be shipped without a license. Thus far for Nvidia or AMD's equivalent. But it does feel as though there's this tension going on. Will we allow Grace Hopper, in fact, underlying technology to be shipped out from Nvidia's perspective? This isn't Blackwell yet, and this is something we'd heard Trump talk about before. Would we even let a more dumbed-down version of the Blackwell architecture get into China's hands? At the moment, it's still just the previous iteration, and this is something that's just going to go on as this narrative continues to butt heads over in the administration. Of course, Nvidia is desperate to get back into China. At the moment, it's able to win over and beat analysts' expectations on its earnings with 0% of sales going to China, but they are really keen on getting back into that particular market.
Let's talk for a moment about Amazon, because Bloomberg has a story out today showing that they actually have more than 900 data centers, more than maybe we previously thought. Is this an overbuild, or is this, table stakes for the top competitors?
Well, they are the #1 provider of cloud, and they would like to remain the #1. It's interesting, back in 2023, Adam Selipsky at that point was the head of AWS. He hinted at this. He said, we have 3 times the number of data centers or data center capacity than our nearest rival. That was Microsoft at the time, and we knew Microsoft had 300 locations. So now we understand, due to all the documents that Matt Day's gone through, there are 900. But what's interesting is how many are co-locations. Overall, the majority are owned and operated by Amazon themselves. But they are depending more and more on third parties because they have to. They need to be at the edge. They need to be in metropolitan edges. And they have to, therefore, use other users, like maybe big telecoms companies, let them have access to certain servers. And they can, therefore, offer the training data that is necessary for all of these companies right now. Look, AI demand, we understand, is insatiable. No wonder AWS wants to be at the forefront and keep on building out. But just extraordinary, the numbers that you're looking at. What was it, 420 co-location data centers in 2024, 220 additional rented edge locations. It's vast, totally vast.
Can I ask about Alphabet? Because it did well last week as many things were selling off. First about Berkshire Hathaway, and then this report from The Information that Gemini's advances were so great that Sam Altman himself was worried that he'd issued a memo to staff saying that the vibes were rough or something along those lines. Caroline, it doesn't seem very good when sort of the guru of AI, the person we're supposed to be turning to, is all of a sudden talking about rough vibes because the competition is beating them out.
Well, Sam Altman actually quite publicly said, well done, guys. This is doing incredibly well out there in terms of your model capacity. Even Elon Musk went out there to congratulate the head of DeepMind as well. So clearly, Alphabet has shaken up the market with the dominance of Gemini 3. Many had sort of put Google off for dust, sort of thinking that, yeah, they helped come up with the transformer, but then they lost their leading edge. No, this is a company that continues to be able to innovate at the very highest ends of generative AI. People are blown away by Gemini 3, but this is where we get the Alibaba story that you hinted at. We keep getting more models. They keep being more sophisticated. At what point do they become commoditized more broadly? And I think there's a story that you really pointed out a little bit earlier, the KKR version of this, the worry that maybe they're having to be really specific about which model developers they're going to lend their data center capacity to and build out to. Yeah. They want to ensure that they have an end user, because what if this does end up becoming commoditized more broadly? Right.
They want to make sure they have an end user. They want to be in the top markets. They want to also provide power. KKR working on all these things. The whole private credit story within AI is amazing, but also the fact that Google makes its own chips for Gemini 3. So
vertical integration.
Not only competition for Sam Altman and OpenAI, but also for Jensen Huang and Nvidia. Caroline Hyde, thanks so much for joining us. A lot to talk about, obviously, in tech today, as every day. But retail still remains in focus because this week we have earnings from Best Buy, Dick's, KOHL'S. They all report tomorrow, giving an insight into the U.S. consumer as we head into the holiday shopping season. We also get retail sales data out tomorrow. Joining us now is Bloomberg retail reporter Lily Meyer. So, Lily, it's not all about tech. We still have to be spending money. And how's it going to look at these stores that we're looking at tomorrow?
Yeah, I think these stores reporting will be a really interesting window into the consumer and how the consumer is doing, especially as we head into the holiday season.
And how much of it is what we're going to hear from these companies is that they're trying to appeal to more higher income consumers? The KOHL'S of the world that maybe was a more mass market type product, have they started to change their strategy?
That's a great question. I don't know if they've explicitly changed their strategy, but with Gap, for example, they reported last week, and one thing they shared was that higher income shoppers were heading there. So it'll be interesting to see if, with these other companies, they're seeing higher income shoppers trading down and switching to KOHL'S rather than a department store or something like that.
And quickly, Lily, KOHL'S this morning announcing that they have appointed a new CEO after an interim role. What changes could that mean?
Yeah, so I think it will be really interesting to see. He's been in the role since their last CEO, Ashley Buchanan, was fired. And he's largely been putting Ashley's strategy in. And it seems to be working so far. So I think tomorrow will be another check to see, how is this going? Are they able to kind of get back? Because they've really been struggling over the past few years.
All right, Lily, thank you so much. We'll see what those earnings and the retail sales report brings. That is Bloomberg's Lily Meyer. Now, in pharma news, Novo Nordisk's pill version of Ozempic has failed to slow Alzheimer's disease in a pair of large studies. Despite being a long shot, the shares are plummeting, down nearly 10% on the news. Joining us now is Bloomberg senior healthcare reporter Naomi Kresge. Naomi, how important was this for Novo in order to get results that showed that it was improving on the fight against Alzheimer's, in order for them to improve against the fight with Eli Lilly and their market dominance?
Yeah, so I mean, we've seen a massive share plunge on this today, and I think that it's really down to two reasons. The first is that this trial was many investors saw it as Novo's way to show some differentiation in the short term, like Novo's way to kind of come out of the doldrums in the short term, and that did not happen in the study. It was a failure. And the second is that often, in a study like this, pharma will point, if there's a failure, they might point to some subgroup or some small thing in the study that showed some signs of being beneficial, and there really wasn't any language like that in the statement today. They were very straightforward about it having not worked, and they're in fact going to halt an extension of the study and just stop the trial.
Naomi, is there a concern that Novo has kind of fallen behind in the weight loss battle? It's got the semaglutide, Ozempic, and of course Wegovy, whereas Eli Lilly has this tirzepatide. I don't know the difference, but it seems like, and maybe that's just marketing, a more advanced drug. Zepbound gets better results reportedly. Are they losing ground in this battle?
Yeah, they're definitely losing ground. And I mean, there was a head-to-head study that Eli Lilly ran last year in which Zepbound beat Wegovy. And, it has shown, Zepbound has shown higher levels of weight loss in trials. And this is something that Novo has just, struggled to overcome.
All right, Naomi Kresge in Berlin, thanks very much for joining us. She covers healthcare and Novo Nordisk out of Europe. Check on what's going on in futures this morning. We have gains of 0.7% on the S&P. NASDAQ futures with tech stocks climbing up more than 1%. And Bitcoin continues to fall. A little bit of a rebound now at $86,000 even.
Yeah, is that a problem, though? If Bitcoin continues to fall, does that act as a leading indicator for retail that's going to, at some point, sell the overall market? Coming up, we turn not to retail, but to the professionals. Ray Dalio says that the hedge fund model that's taken Wall Street by storm may not stand the test of time. Meanwhile, Bill Ackman readies his own big play with a possible Pershing Square IPO. We're going to have all the latest for you next on Bloomberg Open Interest.
Let's get to high interest now. Look at what's making headlines around the world. Ukraine's President Volodymyr Zelenskiy says his country risks losing its key ally after Washington threatened to cut off weapons and intelligence unless Kiev accepts a U.S.-Russia peace plan. The proposal would force Ukraine to give up territory, slash its army, and abandon NATO hopes. Zelenskiy's European allies, including France, Germany, and the U.K., backed him in rejecting the plan, calling it a de facto surrender to Putin and Moscow. BHP Group has abandoned a fresh takeover attempt for Anglo American after the smaller miner rejected its offer, saying it wasn't better than its planned $60 billion merger with Teck Resources. The move ends BHP's surprise effort to disrupt that deal and shifts its focus back to major copper projects in Chile, Argentina, and Australia. You can see BHP Group shares actually moving lower, and although both are very little changed. Watch out, pod shops. Ray Dalio is not buying the hype. The billionaire Bridgewater founder says the multi-strat hedge fund model dominating Wall Street won't stand the test of time. He spoke on Bloomberg's Odd Lots earlier.
I think it's not going to last. There's different ways to play the game. That's a totally valid way to play the game. Maybe it's a totally fine way for the investment management, but it's not a fine way for building a 50-year-old. I did this. I built a 50-year-old organization.
For more on this story, we're joined now by Bloomberg's chief Wall Street correspondent, Sri Natarajan. I mean, Sri, it's been around for 35 years. That's not too bad.
It's like the difference between me and Dani, Citadel and Bridgewater.
And you'd be much better at 50 than Matt Miller.
Oh, that's very kind of you to say.
But look, I mean, if you had to think about it, his point here is, and again, you have to look at where Ray Dalio is coming from. He built Bridgewater from a 2-bedroom apartment in New York in 1975 to one of the world's largest hedge funds. It's been around for 50 years, and it is known for its, shall we say, unusual culture, radical transparency, open disagreements, recording meetings, asking people to rank colleagues based on their attributes. So when you build a culture like that, everything else does seem a little different and a little weird. And his point seems to be that a lot of these multi-strats, so-called pod shops, they might be great at making money, but they don't necessarily build a fantastic business legacy. Ken Griffin would perhaps beg to differ.
Izzy Englander.
Izzy Englander would beg to differ, and investors might beg to differ because the investors in these firms don't really care about Ken or Izzy's legacy. What they care about is, are they making a good return on their investment? Which means if these firms are performing, irrespective of how the broader markets are doing, they're happy. Having said that, you have to realize not all pot shops are made the same. There are enough variations. Yes, they all pool out money to these traders that almost operate as these independent shops. But the way it's done at different places is different. Some people pool their risks together. Some people just let them off on their own, give them strict risk limits, ask them to operate that way. At the end of the day, the differentiation is on December 31st, year after year, you look at how the performance has been. And if over 5, 10, 15 years you continue to perform well, that means you have a model that works and that will succeed. And there will be some pot shops that won't work.
And it means your employees are getting paid, right? Because I get his point, which is the broad point that if they're not working together, they can't build a collegial sort of collaborative sense of school spirit, right? And I understand that. But the main thing that these women and men want is to get paid a lot of money, right? So if they get paid a lot, they're going to stay and they're going to have real school spirit. And if they perform well, that'll happen. If they don't perform well, they won't get paid and they're going to leave.
Right, so we touched it from the investor perspective, but Ray Dalio also talked about the point of whether it will be psychologically rewarding for employees to operate in a structure like this. And I think your point is valid. Making $5, $6, $10 million a year, year after year, is plenty psychologically rewarding, at least on Wall Street.
It doesn't go further than just making money, but it's like actually touching investments. Because you could be a researcher at Bridgewater and come up with all these theses and have no idea as to whether or not it actually gets implemented. But if you're in a pod shop, you actually get to invest money. Isn't there a huge lure for that, for talent, to go to a pod shop versus just a huge research operation?
Yes, there is great risk and reward, but I mean, that's the kind of talent that Wall Street normally attracts. People who are confident in their own ability. And if you tell them, here, I'm giving you a massive pool of money, do with it what you want, you have strict risk limits. As long as you're within that, we will keep backing you and you can keep making money. Yes, that is quite the motivation.
By the way, that's a great point. And I think it counters my cynicism, right, about just wanting to make money. Like,
No,
they
I
actually
think
want to affect
the two go
what they're
hand
working on.
The two go hand in hand, though, right? Because money becomes the sort of gold star in your ability to manage money. So you can't have one without the other.
But it's not as shallow, so I commend you on that
could be
point.
shallow, too.
I mean, the difference also is silly, as we pointed out, right? Citadel and Millennium have been around for a long time. Like 3.5 decades is a pretty decent amount of time, and it's almost as long as Bridgewater's been around.
And investors have been flocking to them. Millennium, $81 billion. Citadel, about $71 billion. Those models have proven themselves to be good, successful, and able to attract investors for the long term.
All right, Sri, great having you on the program. Really fantastic story. Reading high on the Bloomberg terminal, needless to say. Coming up, Lori Calvasina of RBC Capital Markets joins us to discuss whether the pullback has run its course. Have we seen enough with a 5% drawdown from peak to trough? We'll put that question to Lori next. This is Bloomberg Open Interest.
I'm not worried about the economy. What I am a little bit worried about is that the Fed is kind of dragging its feet. So I would agree with Neil's comment, like the Fed needs to cut, but not to save the economy, but to see the full rotation into these lagging parts of the market, the interest rate sensitive parts of the market, which is really our story for 2028 or 2026. We think the 7,800 is dependent on the earnings cycle broadening out.
That was Mike Wilson of Morgan Stanley speaking with Bloomberg TV on his outlook for equities with a 7,800 price target for year-end 2026. Lori Calvasina, RBC Capital Markets head of U.S. equity strategy, writes, quote, a short-term pullback in the broader U.S. equity market has been long overdue for a number of reasons, in our opinion, despite our constructive view on the year ahead. And Lori joins us now. Lori, you've also been sort of looking through the wreckage, I mean, if you can even call it a wreckage of last week, and trying to discern whether that the pullback has run its course? What are you looking to figure that out?
Yeah, look, and I think it's TBD, and I know nobody likes that answer, but that is intellectual honesty. Look, we're watching valuations, which on an FY2 basis have been kind of bumping up against ceilings since August, right? And we've seen some improvement there. We haven't seen a ton. I don't know that valuations are going to give you sort of the magic bullet to tell you to get in or get out. We are going to cycle into a new year of earnings relatively soon. I'm watching AAII net bulls very closely, and I think what I'm seeing there really summarizes how I'm thinking about the broad market generally right now. We saw net bulls fall to about minus 11% last week, and the 4-week average is a little less than minus 5%. If you look at where that 4-week average is, it could absolutely have more room to fall, right? We haven't even hit one standard deviation below the long-term average yet. But if you take, sort of the levels we're at and you look at what they typically signal about 12-month forward performance in the market, you tend to get about a 10.8% forward return. So, short term, are we out of the woods yet? Hard to say. But on a longer term basis, I do think the good news is sentiment's already been pretty bearish.
I mean, what is, you think, the main driver? Because before Friday morning at 7:30, it looked like the AI concern was the main driver, or AI optimism. Yeah. And then John Williams came out and said, near term, we still need cuts. And now it looks like the Fed is the main driver again.
So I think all of these things have been contributing. And when you have extended valuations, lots of little things, I hate to use the word cockroaches, right? But I think lots of little problems get magnified. And I think if we look at the Fed specifically, we've seen for several years that if you look at how many Fed cuts are priced in over the course of the next year, and you compare that to S&P 500 performance, or if you compare that, frankly, to small versus large, and Russell 2000 tends to be a rate cut bet a lot of people like to make, both of those, you can see the reaction, just in the real time, right? When we're putting more cuts in, small caps tend to do well, market tends to go up. When you take those cuts out, small cap tends to lag and the broader market tends to stumble a bit. And so we reverse that. I wouldn't ignore what's going on with Bitcoin, and it's not my area of expertise. I don't know why it's going down, but it does tend to be a good leading indicator as well. All
right, Lori, we're going to keep you with us through the opening bell. We have futures ahead of the opening bell that are up, although as you see, Bitcoin right now pointing down 2.25%. We are moments away from the start of trading on this Monday morning. This is Bloomberg Open Interest. I'm Matt Miller. We're looking at green on the screen after we did not turn around and sell off into the close on Friday. We ended higher because of optimism that the Fed is going to cut rates in December or swinging in that direction. S&P futures up 0.6%. NASDAQ futures up 0.9%. The small caps doing a whole lot of nothing. You've got an IPO at the New York Stock Exchange, XEO ringing the bell there. So this kind of animal spirits is still alive. And then we have I think it's a REIT, VERT, a real estate fund there, trading at the NASDAQ, ringing the opening bell. We are really continue to be focused, obviously, on the tech story. Yeah. It rules, and the AI, the Gemini 3 announcement last week really, I think, has changed the way a lot of people feel.
You told me in the break you're going to switch from ChatGPT to you're actually going to do that.
The Gemini 3, well, for my personal account, because I have a work ChatGPT account, so I still have my feet in both camps.
Okay, I think you're an interesting case study, because the question in this market, and Sam Altman said this in a memo to his employees, that the vibes are rough for them because Gemini, their update, was so good. You can see the impact in the stock market. Alphabet shares up 3.6%. It was up all of last week despite some of the bigger ruptures. Is it going to be eating everybody else's lunch? Is this not everybody is a winner? Is it a winner takes on? Is that winner increasingly becoming Google? Amazon, those shares also up 1.5%. There's some documents that Bloomberg analyzed showing that their data center operation is much larger than commonly understood. Does it mean that they get all the capacity? And worth just taking on Nvidia, that is struggling to hold a bid. There are hopes that the U.S. will loosen some of their export rules for Nvidia into China. Maybe troubling, though, that those shares aren't gaining this morning, Matt.
Yeah, well, I think the most interesting takeaway from the Alphabet story isn't that Gemini 3 may be better. I'm sure that it's a horse race where someone's always going to be pulling ahead. But the fact that they use their own chips to train this model, and they are cheaper and use less energy than Nvidia's chips. So this is the same thing we hear about the Chinese AI, that it's less energy intensive, and that has to be a good thing. Novo Nordisk shares are plunging after the drug maker said a pill version of its Ozempic drug for weight loss failed to slow the progression of Alzheimer's disease in 2 large studies. They didn't tell us if those people got a lot skinnier, but apparently they didn't improve with this horrible disease. I think more and more people are coming in contact with as the population ages. So struggling to find some relief there, and also a new use for their pill. Lori Calvasina, RBC Capital Markets head of U.S. equity strategy, is back with us. And, it's the consumer that we're thinking about this week, as well as the tech, private credit, and Fed stories, because you have Best Buy tomorrow, because we have Dick's Sporting Goods. There's some other retailers coming out.
And retail sales.
And retail sales as well. How strong is the link between the consumer and the S&P as retail investors play a much bigger role in investing? And, I think that's what we're seeing in Bitcoin as well.
I think you sort of hit the nail on the head, Matt. Like, we talk about the K-shaped economy, weakness at the lower end income consumer, and that not, sort of filtering into GDP as much. But I think the sentiment link has probably grown. And one of the things we've pointed out, a number of times in recent years is that if you look at the year-over-year price in the S&P 500, or frankly even the Russell 2000, and the University of Michigan Consumer Sentiment Survey, there has been a very strong link between those two things post-COVID. And I think that's just an expression of how, maybe retail investors are having a bigger influence, or frankly, even how institutional investors are acting a bit more on sentiment. So I think that's very important. One of the things we said in our weekly this morning about that University of Michigan consumer sentiment data is it's really bad, but from a strategist perspective, it's so bad you do have to be on guard for reversions. And I know those are always sort of tough, to think about, when you're looking at this data point, right, that's kind of hit this new low and gone below, sort of important lows that it's made in the past. But you have to keep a clear head when these things, are pretty lousy, frankly.
I do wonder, though, if the increased participation of retail goes back to a point that you were making before the break, that the AAII survey, you've seen a lot of those individual investors be outright bearish, that maybe institutions are more sort of on the bearish side. Howard Marks gave an interview to the FT this morning that basically said the buyers of this market have been traders and not investors. Do you think that a lot of the melt up that we've seen so far this year has been that? It means that there is more fragility in this market.
So, if I go back to the summer when I feel like the institutional community was pretty bullish, I was hearing a lot of excitement over the tax bill and CapEx is coming. I was hearing a lot about rate cuts are coming. I was hearing a lot of just sort of general excitement about the economy. And as we look here, right, and we're in sort of this data, I don't exactly want to call it a data blackout, right, because we're starting to get the information in, and we actually have had a lot of good alternative data. But I think, there are some questions of, okay, maybe, I'm not really hearing the R word being used, but maybe things are a bit more wobbly than we thought on labor in particular.
Neil Dutta was using the recession word earlier, just a couple hours ago, saying that if we don't get rate cuts, there will be a recession, that he thinks things are that fragile. Would you agree with that?
It's not what I've been hearing from institutional investors. We may be talking to different people, to be honest. But I would say, it's certainly not on our economists' radar. I mean, they're looking for, I think, 1.6% real GDP growth next year. So they do think that sort of the impact of a lot of policy things we've gone through this year are maybe having a bit more of an impact on growth than, some in the consensus, frankly.
Well, but maybe because we are going to get rate cuts, right? I mean, President Trump is not going to put somebody in charge of the Fed who isn't going to deliver rate cuts, and he gets to replace a few different people on the FOMC. So he's going to get his wish, right?
Well, if you look back over the history of rate cuts over time, at least since they've been announced, it is really hard to fight the Fed. The only time we really tend to see stocks go down on a 12-month forward basis after you get some kind of cut is if those cuts are associated with a recession, either a pre-recession cut or a during a recession cut. If you're not associated with a recession or it's coming after a recession, you tend to have, pretty powerful returns, to be honest.
But don't fight the Fed. Like, who are we fighting at this point? Because at the moment, sure, even if Trump puts in a pick who wants cuts, you've already heard from 5 members on the FOMC who have said that they don't want to cut in December. who are you fighting? Who do you listen to when you don't have consensus building on the Fed anymore?
Well, I think this goes back to, valuations are sitting where they are, right? And so if you go back to the summer and people were pretty certain that these cuts were coming, and now you've got some doubts, well, maybe it's not going to be quite as many as we thought. I had one investor tell me, frankly, who had been pretty bullish on rate cuts over the summer, tell me, not too long ago, well, this is all kind of baked into the market, and we've pulled all this good news forward. So I think there's that dynamic as well. And I think the reality is if you weren't sitting at these valuations that were bumping up against ceilings, this kind of debate wouldn't necessarily take as much of a toll on the market.
By the way, there is the theory that the president could arrange a dismissal of all the 12 regional Fed presidents and put his own people in place there as well. I only know this because I spend 2 hours a day listening to Balance of Power. Like every single day I'm listening to our politics coverage, which is fantastic, by the way, and I recommend that you do as well. But how much do politics matter to this market? I mean, how important you mentioned one big, beautiful bill, right? We have the midterm elections not too far away. How key is it to pay close attention?
So what we've said on the CapEx issue is that this is a show me story, right? There's some good stuff in the bill from a CapEx perspective. We haven't heard companies saying a ton about CapEx plans outside of sort of the tech space. But, we are getting a little bit more than we were. So it feels like it's headed in the right direction.
It's free money, right?
It's free money, and look, there was one bank early on in this past reporting season that said they were seeing some customers who had been renting. I think they were talking about equipment, I'm not totally sure, but they were saying kind of moving from a rent to an own mentality. So that's a good step in the right direction, right? We heard another bank that said they were seeing an interest in CapEx, but a lot of that was tech focused, right? As opposed to like building factories. So there are a lot of nuances to this. I tell people, just watch ISM new orders. It tends to lead actual CapEx spend by about a year, and that's been sort of meandering along at very weak levels. I do think just more broadly, midterm election years do tend to be sort of a weak spot for the equity market. I think that's a risk factor you consider for next year. And it's funny, we haven't gotten a whole lot of questions about midterm elections recently. It's all been about AI, a little bit about Bitcoin earnings. But I've been sort of curious as to when those election questions are going to start popping up.
We can only focus on like one horrible or disruptive thing at a time, Lori. I think maybe that's why. Lori, thank you so much for joining. Always a pleasure to have you on. Lori Calvasina of RBC Capital Markets. A check on your equity market about 9 minutes into your trading day so far. We are positive, but some pretty bad breath. We're up 0.8%, but only 177 companies are leading us there. The reason that we can get up there despite bad breath is that it's a lot of these big tech players that are doing well today. Broadcom, the biggest gainer, up by 11.7 points is how much it's lifting this index, followed by Alphabet. We've been talking about how that new Gemini model has been so good that Sam Altman is warning about bad vibes for OpenAI, followed by the other big Mag 7, Apple, Tesla, Amazon, Nvidia also flipping into the green after a little change to start the day. To the downside, you do have Oracle that's not been able to catch a bid. They've been the poster child for spending on debt in this debt market without a clear return. You also have oil not doing well. PNG, not a clear reason that they're down this morning, but it is, as Matt's been pointing out, an important week for the retailer. If you look at the overall indexes and the different sectors within them, oil, energy, that is at the bottom. Oil prices have been falling. It's down 1% so far this morning. Potential hopes for a peace plan in Ukraine has meant that oil prices have come in. There's also a report that she will be speaking with Trump by phone on Monday. Will they talk about Ukraine? Will they ask them to push Russia in a certain direction? Meanwhile, the best performing sector are communication services. That's a lot of Alphabet in there, Matt.
Yeah, a lot going on in Google today, and we're going to keep talking about that. Coming up, Amazon quietly expands its data center operation to more than 900 spots. We'll have details on all that is tech next. This is Bloomberg Open Interest.
About 15 minutes into your trading day, here's where we stand, and it is a tech market that is leading us higher by 1.4% in the NASDAQ 100, with Broadcom, Alphabet, those shares outperforming this morning. Some of your other top calls, the analyst action that we are looking at, Wolfe Research, they have raised Morgan Stanley to a buy, saying that accelerating investment banking growth and strong wealth management is helping to support higher earnings. The analyst there also set a street high price target of 198. They're just below 160, higher by 0.7%. Next up, Goldman Sachs kicking off coverage of European automakers with a buy rating on Ferrari, BMW, and Mercedes, citing strong balance sheets, robust cash flow, and resilience against Chinese competition. Analysts said that the luxury trio are best positioned in what they call tumultuous times for European automakers. Ferrari shares listed in the U.S. little change this morning. Finally, BNP Paribas initiating coverage of Alphabet with an outperform rating and a price target of $355. Analysts cite the company's strong AI leadership, resilient ad trends, and cloud profitability as key drivers of growth. Does that imply that BNP didn't have a price target on Alphabet before? I find that hard to believe considering they're huge, but there you go, those shares up 5.8%, Matt.
All right, maybe they suspended for a little bit, but let's stay in the tech sector right now because Bloomberg Research has found Amazon has quietly expanded its data center operation. Its footprint now includes over 900 facilities in over 50 countries. For more on all things AI, and believe me, we're going to talk Google and Nvidia as well. We're joined by Mandeep Singh. He's Global Head of Technology Research for Bloomberg Intelligence. Let's kick it off with the Amazon story, although I think it's fair to say that we're both more interested in Alphabet today. So they have a bazillion data centers. Like, I'm actually not moved by that. I could have guessed it, and I don't think it really matters, right? How many actual places they have, does it?
I mean, right now, when you compare them to a CoreWeave, which is a pure play data center play on the GPU side, CoreWeave has about 32 to 35 data centers. It's got 250 plus 100,000 GPUs, and they have a $5 billion revenue run rate. Amazon is like 130 billion plus run rate, so almost 30 times. So it doesn't surprise me they are around that 900 mark when you look at CoreWeave's footprint. But the real challenge for Amazon is they don't have the GPU capacity that some of these neoclouds have, which is why their backlog has trailed the likes of Microsoft and Google. And now they are being more strategic about it.
So this is where I'll be the one who asks the dumb question, right, for the guys in the back row here. Why does it matter if you have data centers all around the world with lightning fast fiber? Can't you just have one that has like 50 gigawatts of compute? Why do you need these edge centers like near New York or near LA?
So Matt, you're serving a large language model with 1 trillion parameters to over, let's say, 1 billion users. And not all the billion users are in that location. They're opening a data center, but that's where these models need so much compute. They require, 1 trillion parameters to be loaded in that server or the GPU.
But it has to be regionally accessible. I thought the idea was...
That's how you minimize the latency. I mean, anyways, these models take a lot of time. That's the biggest criticism, that they are slow. So how do you serve that traffic, which it could be billions of users, and that's why you need these edge locations to really cache and make sure your users have a good experience with the LLM.
Okay, I thought I was more interested in Google, but now I have more questions on this, Mandeep. Okay, if you are building this out and you have all these data centers, you have 900, does that also kneecap your competitors? Is it also harder for them to find the land to get the data centers if Amazon is buying up so many?
Right now, they are in land grab mode because there are very few facilities with the kind of power requirements that these GPU centers have. And look, I mean, everyone is trying to make sure they get a hold of them because earlier it used to be 3 players. Now you've got 10 different neoclouds that are also scrambling to get a piece of that data center pie.
By the way, it's not just latency, right? The other big problem is hallucination. And you point out that Gemini 3, Google's new advancement, has a greater ability to curb AI hallucinations. And they do it using their own chips that need to be powered by less energy. So it's like a win-win-win here for Google and a loss, in a sense, for OpenAI and for Nvidia.
I mean, look, vertical integration has always proven to be a better strategy. The question was, in this case, could the TPUs from Google match up to Nvidia GPUs in terms of performance and tokens per watt, which is the key metric? And in this case, TPUs are in their 7th generation. So Google has been doing this for more than
the Tensor.
The Tensor processing unit. And that's where other custom silicon efforts have still not caught up to NVIDIA because they're in their 2nd or 3rd generation. So, look, Google has the search index, which is where I think it's their other big differentiator that no one, even OpenAI, doesn't have the search index for the web that Google has. So their results are grounded a lot better than any of the other LLMs out there.
So when Sam Altman warns of rough vibes and warns of revenue that will take a hit because of the competition, because of Gemini edging ahead, how does that change OpenAI's behavior in the race?
I think they will be more product-centric and more application-focused now. So whether it's e-commerce, which is where they can really hurt Google, because let's say OpenAI really doubles down on e-commerce with ads and integrating with a lot of marketplaces. That's where bulk of Google's search ad revenue comes from. The $200+ billion in search ads are tied to e-commerce. So that's where I feel OpenAI is really going to either release a new model, new functionality, because e-commerce is the place where you can hurt an Amazon and a Google and all these incumbent players.
And notably a place that delivers revenue, which is something everybody wants to see right now. Mandeep, thank you so much for joining us. Mandeep Singh of Bloomberg Intelligence. Coming up, the financial version of a deboned turkey stuffed with a duck that's been stuffed with a chicken. We'll explain the rise of the Turducken investment trend. That's coming up next on your Thanksgiving Day week. This is Bloomberg. One of the biggest fads of the COVID retail trading era is making a comeback. SPACs are now launching onto crypto companies and quantum computing, much like a financial turducken. Bloomberg's Bailey Lipschultz joins us to explain and explain what you're going to have to do. How does this look like what I'm sure is a delicious food item of the turducken?
So the way that the visual does it perfectly, I would say. So basically, SPACs or blank checks, they partner up with a private company, take the private company public. But in this new iteration, in the era that we saw of the digital asset treasury kind of taking off, you take the crypto and you put it in the treasury company. And then you take that company and you merge it with the SPAC. So I think that's crypto's your chicken, treasury companies, your duck, and then the SPAC is your turkey.
I mean, to me, it seems like greater fool theory cubed, right? Because the only thing holding up the price of Bitcoin is the fact that you can later sell it on to the greater fool. The same is true, really, of treasury companies. I mean, what's the growth in treasury companies, right? And then a SPAC is just another version of that. So,
well, the main critique of these DATs is that your whole process to that point is you're going to be able to sell shares or convertible debt at a premium. As long as you trade above net asset value, something that Michael Saylor had kind of latched onto and was executing quite well, that's the whole vision, and that keeps driving up Bitcoin. Does it drive a circle? I let other people debate that. But the thing with a SPAC merging with a DAT is that not only do you have kind of the issues of the DAT hoping that it trades at a premium, you also have the founder shares coming from the SPAC.
By the way, why do you say merging? From an old school Bloomberg journalism perspective, isn't the SPAC buying the DAT?
See, people say that, and I think it's a little bit of a misinterpretation because that implies that the SPAC is outright taking over the DAT, whereas it's only getting a portion of it. So when you look at the Cantor deal, only about 3 to 4% of that ultimate company is going to be held by the SPAC. So it's really a vehicle to take it public, but it's not taking over in the sense that it's majority held.
By the way, did we show the stock of the Cantor SPAC? Because it's amazing how it just jumps up right when they make the announcement. And then I guess the smarter investors sell out over time.
You're kind of regressing
leaving
to
the retail investors holding the bag. Is that the case?
Talk about greater fool theory. This is essentially a trading vehicle. And if you talk to most fundamental investors, they'd say, okay, well, if you're buying maybe a SPAC that's taking a quantum computing company public, okay, maybe it's worth $11. But when it trades, I don't know, $50, you're kind of just using it as a trading sardine, as they said back in the day.
Just quickly, Bailey, though, if we keep getting weeks like last week, surely this isn't sustainable.
I don't think it's sustainable. We will get the Cantor Fitzgerald vote December 3rd. We will get the Columbus Circle vote December 3rd. So we will actually see a couple of these companies cross this finish line from the SPAC finish line. So it'll be interesting to see if they immediately trade below NAV. Do they trade down to NAV? But for all intents and purposes, I can promise you, Cantor right now trades at about $14. There's not $14 worth of Bitcoin in that company.
By the way, I thought of you when I was reading John Author's column. He says, meme stocks proxied through the Roundhill meme stock ETF that relaunched last month in what now appears to be a spectacular signal that the top has been reached. Bailey Litschultz covers SPACs for us. Coming up next hour, Katerina Simonetti of Morgan Stanley and what sectors will perform best in 2026. And we'll tell you about an anti-anxiety beverage. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Berger. Equities on the front foot this morning, led by tech, after the falls were led by tech last week.
Coming up, we'll talk about that cautious comeback made by big tech as concerns over a debt-fueled investment spree linger.
And retailers hope for a holiday miracle. We're going to get another read on the American consumer as more earnings roll in ahead of Black Friday.
And watch out, pod shops. Ray Dalio thinks that the popular multi-strat hedge fund model won't last nearly as long as the business that he built. But we begin with tech fueling gains this morning. We caught up with RBC's Lori Calvasina on what she's watching.
I know nobody likes that answer, but that is intellectual honesty. Look, we're watching valuations, which on an FY2 basis have been kind of bumping up against ceilings since August, right? And we've seen some improvement there. We haven't seen a ton. I don't know that valuations are going to give you sort of the magic bullet to tell you to get in or get out. We are going to cycle into a new year of earnings relatively soon. So, short term, are we out of the woods yet? Hard to say. But on a longer term basis, I do think the good news is sentiment's already been pretty bearish.
Joining us now is Katerina Simonetti, Morgan Stanley Private Wealth Advisor and Senior Portfolio Manager. And Katerina, Lori also made the point that, we've gone more than 5% peak to trough last week. I think 5.1% exactly. So was that enough of a correction? Is that the pause that refreshes and investors can get back into this market to rally through year end?
Well, Matt and Dani, thank you for having me on the show. We certainly expected this correction in AI stocks specifically because investors are getting both concerned about the valuation and also are questioning how much farther can this market go. And this is just this push and pull about the investments into the strategy versus the productivity that we are expecting, especially right now that these investments are being fueled not just by cash investments, but also by debt investments. So the bottom line is that we have to be realistic about near-term returns. And corrections like we just saw in the AI stocks this month, are going to come. This is something that we are going to see. But overall, we see this trend continuing, and we see a lot of opportunity in this space.
Opportunity, but more questions asked, Katerina. Does that mean that you buy dips when you have sell-offs like we saw last week?
Well, Dani, we have to, one, buy on dips, but also we have to broaden our view of the sector. In other words, we have to try to get away from the names that are overvalued and overbought and are certainly, there's a potential that they're going to continue to grow. But we have to look at the sector from different perspectives, like looking at the companies that are building out the data centers, that are cooling the data centers, providing the connectors, are mining rare earth minerals. There are so many ways of looking at the sectors versus just the core names that we've been looking at that, especially this month, proved to be very volatile.
What do you think about the growing debt pool? I mean, I was looking at the debt issued by these mega cap tech companies, and although it's nowhere near even a fraction of their their market cap, it still is bigger than ever before. And we're investing more in technology, you could say AI, than ever before. Here's Oracle's credit risk. We're showing a picture of the credit default swaps right now, just jumping. Is this a concern? Are we going to see spreads start to widen out?
Debt in itself is not that much of an issue, especially considering that investors at the moment are gladly investing in the space. Once debt is going to start getting scarce, that would be an issue. But as long as debt is available, funding some of this expansion with debt, especially considering the potential productivity results that this can yield, makes a lot of sense, again, as long as debt is available.
Katerina, I just wonder if something has changed with last week, and it was more than just a momentum sell-off, but if the narrative has shifted, if we've gone from an environment where we keep bidding up AI-related stocks because we believe in the superintelligence future, if that's been traded in for companies to show us here and now that there's profitable AI, do you think that that narrative has shifted? And if so, what does it mean about the pace of gains going forward?
Well, it's not that much that the narrative has shifted. It's just that investors are looking at it very intellectually and also are having a lot of questions in terms of AI is technology. That's exactly what it is. And it's newer technology that is being developed. So we see a lot of potential for it. We see a lot of potential in tech, in financials, in healthcare, all across the board. But the question is this technology going to work exactly as expected? And so that's why we need to make sure that our investments are properly diversified, even just looking at the tech, because we are expecting that it's going to work. We don't think that it is a bubble, but we have to proceed cautiously and responsibly.
You're expecting 3 cuts in 2026. What about December?
December is a little bit questionable simply because we had the longest government shutdown in history. So Fed is working on limited data. So naturally, there is a potential that they might be a bit reluctant to come in with a rate cut. Overall, including December, we are expecting about 3 rate cuts from now until middle of next year. And we also think that the lower rate environment is going to be, something that will create great opportunity for financial companies, for example. But December is yet to be seen.
We heard from Governor Waller speaking on Fox earlier saying that he was advocating for a cut in December, but after that it would be a meeting-by-meeting approach. Katerina, what difference will it make if we do indeed get a cut from the Fed, but they don't clearly guide us towards more? Will that hurt the ability of equity's ability to continue to rally?
Well, the expectations is the core part of it. I think market is expecting a rate cut in December, and considering that weakening labor market is one of the biggest driving forces for the Fed, it would be really helpful if Fed line themselves up between the expectations, but it doesn't always happen that way. So I believe that the stock market will be disappointed if we don't see the rate cut in December. Is it the end of the world? Absolutely not, because more rates are coming, and there is no doubt about it. More rate cuts are coming.
Katerina, we'll have to end things there. Thank you so much for joining us. That's Katerina Simonetti of Morgan Stanley. A check on your equity markets this morning, more than 30 minutes into your trading day, and we push higher. We are higher by 1% for the S&P, 1.7% for the NASDAQ, led by names like Google because of Alphabet's Gemini's outperformance. Broadcom's doing really well, too. Your 10-year yield, that's lower by 1 basis point. Bitcoin, though, that continues to fall, is an issue of sustainability for the market's rebound if you can't have the names like crypto moving to the upside this morning, Matt.
All right, let's get a look at some of the single stocks moving right now. Alphabet, we've been talking about gaining amid continued optimism over the latest version of its Gemini AI model, Gemini 3. And we see Novo Nordisk well, here's a bank of tech stocks. And we see Novo Nordisk shares plunging after that company said a pill version of its Ozempic failed to slow the progression of Alzheimer's disease in 2 large studies.
We're also keeping an eye on Oscar Health, Centene, Molina Healthcare this morning, those insurer companies. Treasury Secretary Scott Bessent told NBC that an announcement addressing healthcare costs is planned for this week. Politico also reporting that Trump eyeing a 2-year extension of ACA subsidies. Coming up, Commerce Secretary Howard Lutnick says the decision to authorize sales of Nvidia's H200 chips to China is on the president's desk. We'll have more from that interview coming up next. This is Bloomberg.
Let's get to high interest now. Look at what's making headlines around the world. KKR's Raj Agrawal says the firm is steering clear of the hype as billions get poured into AI and data centers. He warns too much money is chasing too few solid projects. KKR is zeroing in on prime markets like Virginia, fully insured. That's important to him, I guess. Flexible sites, data centers that can serve multiple clients, including the end user. He also mentioned that as key. Anthony the Mooch Scaramucci has weathered a crypto flop, an 11-day White House flame out, and business ties gone bad. Now he's trying to turn his battle scars into lessons. The Wall Street investor has launched the Resilience Lab. It's a $49 online crash course in bouncing back. His message: fail fast, ditch the ego, get offline, and toughen up for a chaotic world. Partnering with NYU's Scott Galloway, Scaramucci says it's time to help young men rebuild confidence and purpose. And President Trump and Chinese President Xi Jinping spoke by phone today, according to China's official news agency. The call follows last month's trade truce in which Washington cut tariffs on Chinese goods and Beijing eased curbs on rare earth exports. No other details on the call were released.
Elsewhere, Commerce Secretary Howard Lutnick says that President Trump will decide whether to let Nvidia sell its H200 AI chips to China. He spoke with me and Lisa Abramowitz in a wide-ranging conversation.
That kind of decision sits right on the desk of Donald Trump, right? He's got Jensen from Nvidia, who really wants to sell those chips, and he's got a good reasons for it. There's an enormous number of other people who think that that's something that should be deeply considered. And the benefit that we have is we have Donald Trump in the Oval Office. He is going to weigh those decisions. He understands President Xi the best. He will decide whether we go forward with that or not. That's on his desk with lots of different advisors. The president loves to hear lots of different voices to make those kind of decisions, and he'll decide whether we sell those chips or not, and then we will go execute it however he decides to go forward.
There's a bigger question here, Secretary Lutnick, about what national security is. Is it more of a national security risk to give China some of these high-powered chips, or is it more of a national security risk to not have U.S. tech in China? Has your view on that changed?
Well, that's the question, exactly as well put and in front of the president, which is, do you want to sell China some chips and keep them using our tech and our tech stack? Or do you say to them, look, we're not going to sell you our best chips. We're just going to hold off on that, and we're going to compete in the AI race ourselves. So that is the question. It's in front of the president. He's going to decide. It's a really, really interesting question. He's got all the information. He's got lots and lots of experts talking to him, and he's going to decide which way he wants to go forward.
Secretary Lutnick, meanwhile, use of IEEPA for tariffs is in front of the Supreme Court. The feedback has been skepticism so far from many of the justices, conservative ones included. As this plays out, can you walk us through how you'd prioritize the different alternatives should the administration's use of tariffs via IEEPA get struck down?
So I was in the Supreme Court. I sat through the whole argument. The justices were tough on the beginning on the Department of Justice's, our person. But then they were much tougher on the other side, much, much tougher. So I left that day feeling very confident that we and the president was going to prevail on these IEEPA tariffs. So I think, you're hearing it from me, I think I was there in the courtroom. I heard it all the way through. I didn't sort of write my story halfway through. I sat all the way through to the end. The president's going to win that case because that makes sense for him to win. But I want to remind you, the president has lots of other authorities. He has 232s, he has 301s, he has 338s, he has a whole variety, 112, 122. He's got all sorts of other powers. And tariffs are going to be part of this administration going forward, but I don't think they're going to be necessary because the president's going to win the IEEPA case in front of the Supreme Court.
That was Commerce Secretary Howard Lutnick speaking with Dani and Lisa earlier. For more on President Trump's upcoming decision on Nvidia's chips, we welcome Bloomberg senior editor Mike Shepard in Washington. And Mike, it's become common now for Nvidia to say in its forecast, this doesn't include anything on China revenue because they can't get it yet. Are they going to in the next quarter?
That is the big question, and it's unclear from the Secretary's comments this morning with Dani and Lisa, and also from our reporting last week, our exclusive showing that the administration is considering whether to allow Nvidia to sell a more advanced version of its artificial intelligence chip to China. It's just unclear how soon a decision might be made or whether one might be made at all. They could be deliberating this one for a while. And reason is, Matt, is that this is such a sensitive move. It would mark a significant break in U.S. policy since 2022, when the U.S. first really cracked down on sales of advanced chips to China, trying to rein in the chief U.S. economic rival in its own quest for AI supremacy. The U.S. is trying to stay ahead in the race for artificial intelligence advantage, and granting Nvidia chips to Chinese companies would be a challenge for keeping that edge from the perspective of some advisors and certainly some lawmakers here in Washington. So we will see how this debate unfolds. Now, one key factor is this relationship between President Donald Trump and Chinese President Xi Jinping. The two men, according to Xinhua, the Chinese news agency, spoke today. They talked more about Taiwan and other issues sensitive to China, at least according to the Chinese readout. So it's unclear whether the question of Nvidia's chips came up.
And there's also the question as to whether Ukraine came up, Shep, because China has a role to play in this as well. I was speaking to Terry Haynes of Pangea earlier, too, who said that China holds a lot of influence in whether they push Russia to come to any sort of agreement. Where do we stand on the actors involved and whether this 28-point plan has any chance of getting accepted by the Europeans?
What we're seeing right now from the Europeans in Ukraine certainly is a lot of pushback and skepticism. They are urging the U.S. to slow its roll. Remember, the president and his advisors had given Ukraine essentially a week to accept what had been presented following these conversations with Russian officials. And Ukraine's immediate reaction and that of many European capitals was, look, a lot of these points, especially when it comes to territorial concessions and security guarantees, do not pass muster. And the question of whether China could exert leverage is an interesting one because China is a huge purchaser of Russian oil, and there also is an affinity between Vladimir Putin and Chinese President Xi Jinping. So there could be both economic and moral suasion in the end if President Donald Trump tries to enlist Xi Jinping to help on this. He has before, and he did bring it up during their conversations on the sidelines of the summit, the APEC summit in South Korea. So we will see how this aspect of the conversation between the U.S. leader and the Chinese leader unfolds and whether there is some sort of influence on the efforts to try to advance talks on peace in Ukraine.
I got to finally ask you about health care. You know, the Democrats closed the government for weeks because they wanted to get an extension of these ACA subsidies. The Republicans refused to budge. Now it looks like the White House is going to float a 2-year extension. Is that the case?
Well, that's according to Politico. We haven't confirmed all of that reporting just yet, but the president and his advisors have promised something of a counteroffer to Democrats. And this is, in a way, trying to answer the broader question of affordability that has come up so much in politics today here, not only in Washington, but across the U.S. It's not just prices for milk and other goods. While the administration will point to certain commodities as having their prices falling, one area where they have not dropped, of course, is health care. It is a sensitive point, and it is what drove Democrats to hold out and withhold their approval of the spending plan that ultimately passed, but not before a more than 6-week government shutdown. So we'll have to see what the administration offers. It may include an extension of those subsidies, but President Donald Trump has indicated that he does not want to make those subsidies permanent. He would rather come up with an alternative. And one idea he has floated is simply handing that money back to taxpayers and consumers. But the issue is it may not address the broader question of health care costs. It simply would put money back into people's pockets to make their own choices and eliminate the subsidies altogether. But it doesn't go further to address the cost issue. So we'll have to see what more they add to this proposal that Treasury Secretary Scott Bessent said yesterday would be coming later this week.
I was going to say, Shep, from health care to even really tariff negotiations, or you could add Ukraine negotiations in that to lowering the oil prices or to meeting with Mayor-elect Mom Dani. How much of the question around affordability is underscoring a lot of this White House and a lot of the actions that they've been taking as of late?
Well, it really is becoming more of a theme. It is a question that the president himself has addressed. And you even heard in the interview that you and Lisa did with Commerce Secretary Howard Lutnick, the affordability question came up, and he tried to take it on really head on and emphasize that he is and other officials are trying to take steps to address it. And yet there is a lot of skepticism about whether the benefits of policies like the tariffs that the Commerce Secretary indicated the administration will continue to pursue may have some downstream effects and trickle-down effects on consumers who may have to pay the cost of those levies and other impacts from policies from the administration.
Yeah, how's that feeling of an arsonist calling the fire department? Shep, thank you so much for joining us. That's Bloomberg's Michael Shepard. Still ahead on the show, Ray Dalio says the hedge fund model that's taken Wall Street by storm may not stand the test of time because, notably, it is not the model that he built at Bridgewater. And Bill Ackman readies his own big play with a possible Pershing Square IPO. We'll have the latest in the hedge fund world for you coming up next.
Let's get a check on the stock market right now. Taking a look at the S&P with the move screen, you can see that we opened in the green. We continue to hover at these higher levels right now at 58 points on the S&P, almost 1% the gain. We're getting a huge boost from these tech stocks. So Broadcom, Google, which we've been talking about a lot, Tesla, Amazon, Facebook, Apple, all putting up big gains. Even Palantir Technologies putting up more gains today after questions have been raised about J.D. Vance's connections to that company. Nvidia is actually down right now, but only about 0.5%. That makes it the biggest loser in point terms, but only because it's such a big company. And then you have Procter & Gamble as we face a week of retail earnings, Berkshire Hathaway, ExxonMobil, Coca-Cola. So more of the consumer discretion stuff here. Or is Coca-Cola may be a staple, actually. You need Coke to survive, right? Is that the case? Let's take a look at the industry groups here on the S&P 500. You can see communication services, which is those big hyperscalers leading the gains, consumer discretionary there, as well as IT. On the bottom, you have consumer staples. That's your Coca-Cola, energy, as well as real estate. Coming up, Trip is looking to make Thanksgiving dinner a little bit more relaxing without the necessary cousins walk. We speak to Olivia Ferdi, the company's co-founder and CEO. Next, this is Bloomberg Open Interest.
As more Americans ditch alcohol, a category of drinks that's new is emerging ahead of the holidays. Trip is helping to pioneer the anti-anxiety beverage industry, which is set to deliver $100 million in annual revenue this year. Joining us now is Olivia Ferdi, the company's co-founder and CEO. Olivia, great to see you this morning. Look, I got to start with the drink itself and what's in it, because if I see a can and it says Trip on it, I'm assuming I'm going to take it and maybe I will trip. That's not exactly what happens if you drink this drink. What is Trip and what's in it?
So Trip is a better-for-you beverage, and it's got these active ingredients that help your mind and body adapt to stress. Things like magnesium, lion's mane, chamomile. So the name is a bit of a play on words. It's about reclaiming negative connotations about mental well-being and helping people in an accessible and convenient way to have something delicious while looking after their mind and body.
But if I choose a drink called Trip, I'm going to want there to be drugs in that. And what you're saying is this doesn't have any drugs. So I'm just a little confused about the name, right? Because I was thinking this is a great way for people to avoid a beverage. Maybe they don't need to consume THC, but they can still get a little high. And that's not what's going to happen.
No, it's more disruptive than that. I think when it comes to marketing, it's important to stand out on shelf and be playful. I think Gen Z is a big part of our consumer base. They haven't grown up with the same kind of connotations around THC, etc. For them, it is something aspirational and exciting and memorable. And that's incredibly important when you're trying to impact someone in an impulse decision at shelf, which is really less than 2 seconds of decision-making, emotional connection.
Olivia, when I go to the supermarket now, I have to say I am a sucker for these these new sodas that have pro and prebiotic qualities, although some of the marketing around that has been questioning. I find them really fascinating. And every time I go to the grocery store, there is a new one. It feels like a really saturated market. Is it saturated from your end? And how do you stand out if so?
Such a good question. So gut health, which is a broader health concern where prebiotics and probiotics can be really helped. That's about the 12th health concern of US citizens. Mental well-being when it comes to food and drink is in the top 3. So while there's incredible waves being made by some of these brands and being able to establish themselves alongside heritage soda brands, people are looking more broadly for better for you options. That can be without added sugar. That can be with some functional ingredients like Trip has. Because when you're looking to address your daily mental well-being, food and drink is a really exciting area that customers are reaching for and demanding more support there.
Will you be, though, on a shelf? If I go to Stu Leonard's, do I see you next to the Cycling Frog and, the Harney Brothers, the Heirloom, like these products that actually have active marijuana agents in them? Or,
no.
Or do you go somewhere else? Is it like the health food section?
Exactly. We're very much next to traditional soda, offering a better for you option. So you'll find us in 50,000 stores globally. In Target, you'll find us in the Chiller, Whole Foods, CVS, Vitamin Shop, the full range of grocery to everyday health. You'll find us next to any chilled beverage, whether that is an energy drink, a water, or something with added benefits like trips. We're not actually in the alcohol alternative aisle. Gen Z typically select a soft drink as an alcohol alternative and then continue to enjoy that over an evening, socializing, relaxing. So it's in a slightly separate part of store, more on beverage traditionally.
Olivia, your investors are interesting. You've got models, you've got Ashley Graham, you have Joe Jonas. What is it about Trip that you've got all these celebrity backers?
Well, they were incredible fans. They were brand fans. And it was this lovely organic conversation around them being customers and seeing how Trip was impacting their daily well-being, whether it was for being a busy musician, a mum of 3, entrepreneur, and realizing that you can reach for this instead of a traditional glass of wine and have it throughout the day. And through becoming customers and connecting with the brand, they saw our fast growth. I'm sure we'll talk about our recent fundraise, but the speed of growth for this kind of category that we're leading and defining is something that they were excited to get involved with in a more meaningful way, given the growth opportunity.
So am I going to drink Trip and then I'm going to look like Alessandra Ambrosio or Ashley Graham? Because then I will literally down gallons of it, Olivia.
I mean, you and me both, yeah.
Okay, so you have these investors and you have this new fundraise. What is the plan with that capital? What do you want to do next, Olivia?
Totally. So we've just raised $40 million, valuing the business at over $300 million. The business is already profitable and operating at a global scale. So this fundraise is really exciting because it allows us to accelerate on what is already a very exciting growth journey in the US. That means more doors, more stores, it means more product, and it means really trying to meet our community and customer base as quickly as possible to supply in line with demand.
What about the regulatory issues, Olivia? I wonder, because you can't really make any very strong healthcare claims with like adaptogens and lion's mane. How do you sell that without saying anything?
Yeah, well, I used to be a lawyer, so don't you worry about that. But all of our ingredients are backed by studies. Magnesium is one of the most well-studied ingredients, actually, and has incredible benefits for men and women of all ages. Chamomile as well, ginseng, a lot of these ingredients have actually been around for obviously hundreds of years. So there's a ton of research out there to back up claims. We're obviously extremely mindful about not overstepping any marketing claims and actually let the product do a lot of the talking, as well as some of these wonderful celebrity ambassadors who are able to speak really authentically to their audiences as well.
Olivia, I would also love to know, because obviously like one of the very common ingredients is CBD, and that's in a lot of drinks. I know some of your UK and European versions might have CBD in it, but the US doesn't. Why was that decision made?
We wanted to meet as many people in the market as possible. And for us to be nationwide in the US, it was important that we amplify what we call our mindful blend range. So as you mentioned, the ingredient of CBD is only in our UK line. We've got both the magnesium and the CBD line.
Olivia, great to have you on the program, especially ahead of Thanksgiving. Olivia Ferdi there of Trip. They're offering a beverage that is leading a range of anti-anxiety beverages in the market right now. So first, probiotics, right? You could get your gut right, and now I guess
you get your mind right.
Yeah,
just a whole body experience. Yeah. That's great.
Or you could drink beer and smoke weed at Thanksgiving, like a lot of people tend to do, because you have to be with your parents for the entire day.
Yeah, then that in itself can be very anxiety-provoking. I don't know which would put your mind more right, that or a can of...
One thing that'll make you feel better if you're long this market is taking a look at what's going on in stocks right now. After finishing the session higher on Friday, we're up again today. You can see the S&P here on our giant dashboard up more than 1%. The NASDAQ gaining almost 2% here. And you have the VIX coming down noticeably at the the end of last week, we saw the VIX jump up to Liberation Day levels, and now we're calming down, although still over 20 on the fear index. Nvidia is off right now, but only 0.25%, so it's not as much of a drag on markets as it tends to be. And last week, we even had some updates with Nvidia off. Alphabet, Google, leading the pack here with news that Gemini 3 may be one of the better chatbots out there, and the fact that they made it with their own cheaper chips that draw less energy has investors happy. Novo Nordisk, on the other hand, failing in a trial for its Ozempic drug to help Alzheimer's patients from slowing down the acceleration of that disease. So it's down. Eli Lilly is up. And also, you'll see anybody that's working on Alzheimer's treatments doing well today. Bitcoin continues to drop. Now 2% is the loss, but it's still at over 86,000, so it's recovered a bit from the weekend. And you can see IBIT also recovering and up some right now, 2%. Coming up, Ray Dalio is throwing shade at Wall Street's favorite hedge fund model. We'll explore why the Bridgewater founder says the multi-strat boom won't last. This is Open Interest. Watch out, pod shops. Ray Dalio is not buying the hype. The billionaire Bridgewater founder says the multi-strat hedge fund model dominating Wall Street won't stand the test of time. He spoke on Bloomberg's Odd Lots earlier.
I think it's not going to last. There's different ways to play the game. That's a totally valid way to play the game. Maybe it's a totally fine way for the investment management, but it's not a fine way for building a 50-year-old. I did this. I built a 50-year-old organization.
Joining us now with more insights is Bloomberg hedge fund reporter Hema Parmar. And I thought this was interesting because in the story we point out that there have been a couple of very famous pod shops for 35 years. I mean, that's a pretty decent record, right?
Yes, 100%. So a lot of these hedge funds, the pod shop models, they've been around. Some of them are pioneers that we refer to in the hedge fund space. They're not 50-year-old funds, but they certainly are 20-plus-year-old entities that have existed through a number of cycles in the market. So, but Ray Dalio does say that he doesn't think the model will be as sustainable as his, and has some concerns with the pod structure when it comes to culture.
So those concerns around culture, do they matter as long as they're attracting talent and providing returns?
They are doing both of those things. So when it comes to talent, there is this war that we've talked about a lot. Some of these PMs are getting paid a ton of money to go to these firms, to then leave soon and go to a competitor. So there is this demand for this space, and LP money, investor capital, is going into these pod shops overwhelmingly. So you've seen these firms double in size in the past 5 years when it comes to assets under management.
As long as they're making money, we were talking to Sri Natarajan earlier, as long as they're getting paid,
yes,
you know, they're likely to stay. Mm-hmm. I imagine the incentive is the same as Bridgewater, right? I mean, even if you enjoy this total transparency and people marking off your personality characteristics on a baseball card, you're still going to go somewhere else if they pay you more.
You will go somewhere else if they pay you more. It depends on, if a PM really cares about culture, if they care about running their own money, if they mind having to rate each other in every interaction, these things might influence where they go.
Do they still do that at Bridgewater? Do they still do that?
I think some of the culture has been loosened a little bit, but it's what the firm is known for, right? So when you look at the pod shops, you get to run pools of money yourselves. You get to build a team. It's one way of potentially sort of running your own fund. You see a lot of people that spun out to start launching their own funds, and they realize, well, I could just join a pod shop, have basically the same experience, but I don't need to fuss about the back office or all of those other models of raising money. I'll have capital, I have my team, and I can just execute the money and trade in the way that I see fit.
Isn't it double-sided, though? Because you get that, but aren't some of these pod shops just really brutal? That if you underperform, you're let go. So maybe, yeah, you get that, but less job security.
It's always that trade-off. So the PM needs to decide what they care about the most. Some of these places do have very strict risk limits. You're down 5%, you could be out. So it also depends on the degree of stress that you want. It is, and also how much you're getting paid.
By the way, Bridgewater not necessarily known for being an unstressful place.
True, exactly. No, definitely. It's a very specific person who would like to work there. They've had a great rotation of talent themselves. People don't tend to stay beyond a few years, or they stay a very long time. You sort of see that bell curve. And it's a fascinating experiment when it comes to how to launch a hedge fund.
Yeah, it really, really is. Hema, thanks so much for joining us. Hema Parmar covers hedge funds for us on the Bloomberg News side of the building. Coming up, we're going to set you up for the trading week ahead as big tech leads stocks higher. And we're going to talk with Stuart Paul from Bloomberg Economics. We have a few questions for him. I wonder how we could make healthcare more affordable without the incredible outlays that ACA subsidies will require. That's next. This is Bloomberg Open Interest.
Let's get you set up for your trading week this week. On Tuesday, we're going to get another round of retail earnings. We'll hear from KOHL'S and Best Buy reporting results, plus earnings from Dell and HP. And we'll get some data, U.S. retail sales and PPI data rolling out. Wednesday, we'll get initial jobless claims, durable goods, and the Fed's latest beige book. And then you have U.S. markets closed for Thanksgiving. And then on Friday, Black Friday, will kick off the holiday shopping season. Let's get more on this week ahead. Joining us now is Bloomberg Economics U.S. economist Stuart Paul. Stuart, it is the fog of data that Chair Powell and everybody else is trying to drive through. The much delayed data that we get this week, will it illuminate anything?
I actually do think that it'll be reasonably helpful. The retail sales report that we're going to get for September is expected to show about 0.4% month-on-month spending growth. A lot of that is being driven by vehicle sales, which increased about 2% on the month as people tried to get their electric vehicles before the expiration of the federal tax credit. So when we think about Q3 spending as a whole, it looks like personal spending grew at an annualized pace of about 3%, up from about 2.5% in the second quarter. There was an extended spending surge that went through the summer and through September even. When we look at more real-time data into October, it looks like that spending continued apace even into October. But for a Fed that's trying to craft policy, that's waiting on delayed GDP data, I think the retail sales data is going to confirm that the consumer is reasonably healthy, and we might even be through the worst of the labor market trough. And so there is a little bit more balance when it comes to the Fed making a decision about whether there should be a December rate cut.
Whatever happened to, Matthew Boesler wrote a story in the middle of November. Notice of impending layoffs by U.S. companies surged in October.
These are the warn notices.
Yeah, but does that mean layoffs are coming or not?
Well, so warn notices, they end up getting rolled out. Large companies are required to notify the state departments of labor when they plan to do en masse layoffs. It takes 60 to 90 days for those to ripple through. Companies have the opportunity to second guess their own decisions and actually implement those pink slips and deliver them if they choose to. But all things considered, warn notices have been just at a relatively low level. And when we look at aggregate unemployment insurance claims data, they've been fluctuating in a range of about 220,000 to 235,000. This does not look to be the mass layoff movement that one might have suspected from high-profile headlines.
But the thing is, so WARN is Worker Adjustment and Retraining Notification Act. And then we have reduction in force. Like, we're all learning these acronyms that have to do with a horrible labor market. That can't be good news, right?
Look, these are all acronyms that existed that maybe people weren't paying attention to very much before.
Why would we? Everything was going great.
Right, when the unemployment was so low at 4.3%, you had no reason to pay attention to it. Now that it's at 4.4%, people get a little bit more nervous and they start paying attention to the warn notices.
But surely it's also a bad sign that this is happening, that you get like a Verizon and an Amazon saying they're going to let people go heading into the holidays. Surely that's not what companies want to do. If they're starting to issue these warnings, no pun intended, of them going to lay off people at this specific time of year, doesn't that tell us something?
By the way, Stuart, right after we find out that more than 40 million Americans are on food stamps and those benefits may not have come wholly through, plus the fact that subprime auto borrowers have defaulted at the highest rate on record since the 90s.
So there is something going on that is structural. And when you see Amazon laying off some 60,000 employees, when you see Verizon doing the same, when you see GDP growth in the information industry increasing 25% post-COVID and the workforce increasing just 1%, you know that there are AI-related efficiency gains in a slice of the economy, and replaceable workers, including those who are, let's say, the lower end of the income distribution and the subprime borrowers who typically would be spending on vehicles and trying to finance their vehicles, those folks are going to be struggling. When we look economy-wide, though, it does not look like it's the case that there's this impending doom in the labor market. It looks like there is a little bit of additional balance in the labor market relative to where we were over the last couple of years.
But so in that scenario, it strikes me that rate cuts really aren't going to help, right? Rate cuts are not going to help a subprime borrower get, a lower rate on a car loan, or it's going to go from 27% to 23%, still amazingly unaffordable.
That's right. So monetary policy can address the cyclical. It's really hard for monetary policy to address the structural. A lot of what we're seeing is a structural adjustment. And we also know that throughout both the hiking cycle and the cutting cycle to date, workers and households have been relatively well insulated from the effects of monetary policy. They termed out their debt, they refinanced their mortgages at rock bottom rates. That's the number one mode by which monetary policy transmits into the real economy. We do see folks at the lower end of the income distribution, subprime borrowers who are hurting. But when you look at the rest of household credit products, credit card write-downs are low. When you look at the credit card companies, you look at household bankruptcies, the flow of household bankruptcies is still relatively low. So folks are still relatively insulated from the effects of monetary policy, both when it was tight and as it is loosening.
But you know what? Cuts do seem like they would immediately help. At least that seemed to be what happened in the Williams-led rally. Was that it revives the AI trade. It revives a lot of this equity market. Is there a degree where Fed officials have commented on this too, that AI has been such a big part of this economy that cuts might also be necessary to make sure that that part of the economy continue ahead?
So I think that there's just a lot of fear in markets about the possibility for a policy mistake, right? If the labor market, if the AI boom continues, and AI improves folks' productivity a ton, then it could be the case that you see the labor market deteriorate rapidly, in which case the Fed would want, in theory, to cut. But again, the Fed has to do its business of separating the structural from the cyclical, which is not very easy. At least when folks see somebody like New York Fed President John Williams coming out saying that a cut could be appropriate in December, they're at least given some confidence that there will be a little bit less chance of a policy mistake.
Can I just ask quickly about healthcare, because I teased it and you and I have been chatting about it on the IB. President Trump reportedly, or Scott Bessent said, is going to extend the ACA subsidies for potentially a 2-year period. I've heard from a lot of economists that that would be an incredibly costly way to keep affordability down. Are there alternatives? What else can you do? Because I've been hearing from people who see their costs skyrocketing now.
Well, so there are a couple different factors in play. The first is obviously political, which extending the subsidies would be politically favorable. Affordability is the number one political issue. We saw it in the New York mayoral election. So that's obviously front of mind for the president. When you then think about things like household spending, a federal subsidy could help support household spending. When you think about something like inflation, and how healthcare costs are measured in inflation, it's a little bit trickier because health insurance and healthcare costs within the CPI are inferred from insurance companies' profitability. So if you expand the subsidies to maintain some degree of enrollment, that's a good thing for insurers. So it will show up as some additional inflation within the CPI. If you then reduce eligibility, you start knocking down both insurance company profitability, enrollment, and some of the inflation consequences. So when we're thinking about affordability and consumer spending, all probably a good thing. When you think about the fiscal deficit, bad. When you think about inflation, bad.
Stuart, thank you so much for joining us this morning. That is Stuart Paul of Bloomberg Economics. Coming up on the show tomorrow, Jitanya Kandari of Morgan Stanley, Marianne Bartles of Sanctuary Wealth, and Caroline Stein of the Loop Group. This has been Bloomberg Open Interest.